Welcome everybody. We're going to give it a few seconds just to make sure that everybody can get connected before we kick off properly. We've been very happy with the response to this webinar. The Asia Steel Markets Talking Points is going to be the first one that is focused on Asia. It's our first regionally focused webinar. And we have close to 250 people joining us. We have, I think, almost 50 countries represented from the Americas, from Asia, from Europe, from Africa. And so I want to make sure that everybody has time to connect before we really get things started. Okay, well, I think we're going to kick things off. Any stragglers can join us a little bit later. So firstly, welcome everybody to Asia Steel Markets Talking Points. As I just mentioned, this is the first of our regional webinars, following on from our raw materials focused webinars and our global steel markets webinars. I'm joined today by Ranjiv Mangal, the President and CEO of Tata Steel Thailand, also by Anna Lowe, who is our Senior Reporter at Southeast Asia at Kallanish, and also by Mariam Wang, who is our Senior Analyst in China, also for Kallanish. And I am Tomas Gutierrez in the role as Asia Editor, for those of you who haven't seen me before. So what we're going to do is I'm going to kick off with a few slides. I'll just go through a couple of data points just to set the scene, show what's been going on in different Asian markets, how markets have responded to the coronavirus. And then we're going to go straight into a panel discussion with our panelists. We will be covering the response to the coronavirus, the outlook for the rest of the year, the impacts on raw material markets, how companies can respond to the various uncertainties and risks in the markets. During that process, we will run a series of polls. So please do take part in those. The polls will come up on your screen. They're multiple choice. The answers are all anonymous, so feel free to express your opinions openly. And we will be putting your responses to the panel, so it's a good opportunity to see how our panelists view your responses. Please also feel free to ask questions at any time. You can do that in the panel on the right-hand side. You will see a pull-down menu called Questions. If you drop that down and type in your question, we will see it. I will select those questions to put to the panel during the panel debate, and we will try and get through as many as we can. Any questions that we don't get through, that we run out of time, then we will try to put together a written answer. We will be sending out a written response to all of the unanswered questions to all of the delegates within the coming days. Also, if you have trouble seeing the slides, you can download the presentations from your screen as well. If you look at the drop-down menu called Handouts, the slides should be there, and they are available in a PDF format. Okay. In that case, I'm going to kick off with some slides, and then we'll bring it back to the polls and the panel discussion. So we're going to start off with the Southeast Asian markets. And what you can see here, this is simply exports and imports and net imports. ASEAN is obviously the world's largest importing region, or it has been traditionally. There's been a very clear impact from coronavirus. You can see in the first quarter of this year that actually imports and exports were fairly steady. But once you get to March, April, the point when the spread of the coronavirus became so apparent and when it became obvious that it was going to be a global problem, you can see very rapidly regional imports decline, regional exports also decline, and net imports come down quite a lot as a result of that. And to put it in numbers, net imports are falling from a level of around 4 million tons a month to a level of around 1 million tons a month. So that's quite a dramatic shift, and that's before we take into account any impact on local production. Now, the outlook for that is for a recovery in the coming year. According to the Southeast Asian Iron and Steel Institute, in 2020, there will be a decline in demand of around 2.1%. But in 2021, there's a rebound of 5% predicted. So markets are still have the advantage of having that underlying potential for steel demand growth, which in theory means that there will be growth to come, and hopefully this is only a blip, but we will investigate more in the panel discussion. Moving to Japan, there's obviously been a very strong reaction in terms of production. This has been led by Nippon Steel, obviously banking 6 of its blast furnaces, but other producers have also taken part. JFE Steel also banking a blast furnace, for example. And the link between the closure of blast furnaces and the reduction in hot metal output is what we're showing in this graph, just to show that it really is that decision to close blast furnaces that is impacting production. That decision to close blast furnaces was taken fairly early, and that was really not because of the coronavirus, but because the coronavirus was adding a huge amount of risk on top of an already problematic outlook for steel demand. Japan was already going into a recession. Steel demand was already struggling. Local producers were already in the process of trying to reorganize their production capacity. And so a lot of these closures are simply future closures that have been brought forward. So we now have a situation where Japanese producers have significant capacity idled. Some of that will not restart until next year or later. Some of it may not restart at all as part of restructuring plans going forward. Nippon Steel says that it expects demand in financial 2020 to be down 15% year on year to around 50 million tons. That is financial year April 2020 to March 2021. But I don't know if anybody saw JFE Steel's results this morning. They are predicting a recovery in the second half of the financial year. They don't expect it to make up for the losses in the first half, but they do expect to stop losing money in the second half of the financial year. So that means from October this year until March 2021. South Korea has had a much steadier period than Japan. So if we look here, crude steel output has fluctuated around its expected levels. Net steel exports have also fluctuated around expected levels. Partly that's due to obviously the rapid response to the coronavirus, its early successes in dealing with that. But there have been some causes for concern. In particular, the data for June saw a decline in production and an increase in net exports. That obviously suggests a short-term but quite significant hit to local demand. Having said that, the local producers are moderately optimistic. So in Hyundai Steel's operating reports, it's saying that it expects a stronger second half to the year. In particular, it expects construction investment to be higher. In fact, it now expects construction investment this year to be higher than it expected to be last year. That's obviously as a result really of government spending in order to buoy up the economy. And also automotive output is expected to stabilize in the second half. Shipbuilding is still struggling in Korea, but in any case, they do expect a better second half than the first half. China is obviously the market which has been really driving markets in the last quarter. So if you look here, we're showing end user buying, so real demand adjusted for inventories, and the impact of the coronavirus and that first shutdown from the end of January is very explicit, is very clear, but so is the recovery in the second quarter. So we're now in a position where the increase in demand year on year in the second quarter has equaled the decrease in demand year on year in the first quarter. So that recovery has been very rapid, and obviously that's been driving a range of trends in global markets over the last few months. There's also an important difference within China in terms of where that demand is being generated. If you look at demand over the summer, there's been a very strong boost in flat steel prices and also in manufacturing activity. That's been partly due to very strong support for manufacturing and for encouragement by the government to get the productive side of the economy running at capacity. And it's also been helped out by a very hot summer, which has meant air conditioner sales and white goods sales have outperformed. And automotive is also steadily recovering. But the outlook now is really more about long steel demand, more about infrastructure and construction. China has been loading up a large amount of financing for projects. In particular, the additional 1.6 trillion in local government special bonds compared to last year. That is not only an increase in funding, but it's also the regulations around that funding have been tightened so that the link between that investment and actual steel demand is tighter this year than it was last year. And so the expectation is that in the autumn, when construction and infrastructure building activity really picks up, there should be a stronger reaction for long steel demand in China. One of the key impacts of that has been this surge in iron ore prices, which has disrupted markets. So very strong Chinese demand means very strong iron ore prices. The iron ore market is obviously very focused on seaborne shipments to China, much more so than coking coal, which obviously has a wider set of markets, and also scrap, where China is obviously not allowed to import significant amounts. So you can see here the impact. This is simply the core 62% Fe index compared to our assessment for HMS1 and 28020 CFR Taiwan. And you can see the lines cross, and iron ore ends the chart considerably higher relative to the beginning, whereas scrap prices have underperformed. And that has given an advantage in particular to some EAF producers, but not all, and also to integrated mills that have captive iron ore in particular, which is one of the reasons why CIS mills have performed rather well. And the other key impact of strong Chinese demand is, of course, this flow of Chinese imports. China now a net steel importer since June, for the first time since 2009. The imports have really been driven by a few particular trade flows. Some of those are because their suppliers are close and therefore have short lead times and lower shipment costs, in particular for Vietnamese semi-finished products, for example. Also Malaysian bar and rod. In other cases, because of low production costs, for example, the import of Russian semis, and also because of periods of weak local demand. So in particular, a surge in Indian semi-finished products going into China in June. I'm going to leave it there in terms of the data that we have, because I would like really to hear from our panelists more than to hear from myself. So I would like to welcome the panelists back. Okay, thank you. So I want to kick off the panel discussion with a poll. So I want to start off by asking our attendees to respond to a poll, and then I'd like to put those responses to our panel. Could we have the first poll up, please? Thank you. So the question is, for how long will Chinese steel imports remain high? And the choices are a couple of months, until the end of the year, into 2021, or that it's a long-term trend. We're going to give you around another 35 seconds just to make sure that everybody has a chance to respond. The response is that there's starting to be a clear winner. I won't tell you which one it is because I don't want to prejudice the voting, but we are getting a fairly clear winner at the moment. It's around another 15 seconds just to make sure that you can all vote. We're coming up to around 70% of people have voted, so we're almost there. Okay, thank you. Okay, so we have 43% of you expect Chinese steel imports to remain high until the end of the year, followed closely by people who expect it to last only a couple of months, and some people who expect it to last until 2021. Very few people expect it to be a long-term trend. I think that's understandable considering the longer-term outlook for Chinese steel demand and the fact that capacity is still really quite high in China. I'd like to put those responses to the panel. Rajiv, what do you think of that? Does that fit with your expectations?
Yeah, fairly close. My take is 3 to 4 months, China is likely to pull in material, considering that the construction and the infrastructure work is still strong there. At the same time, their local profit margins to me also looks fairly good. So there's an incentive for them to kind of produce more and sell more.
Yes, I think that's right. If you look at Chinese demand, the outlook is fairly strong. Mariam, do you want to come in and share the outlook from China? And what is the outlook for Chinese steel demand and how that impacts the import markets?
Okay, so China is focused on its own domestic demand, mainly driven by the infrastructure and manufacturing. From our Kallanish prediction, we are looking to see about 3% year-on-year increase in the whole 2020 for the apparent steel consumption in China, and about 2.2% year-on-year increase in the end user demand in China in the whole 2020. So far, in the first half, China has hit about 4.6 million tons for the apparent steel consumption and 4.3 million tons for the end user demand.
So quite strong for the coming months then. And this trend of Chinese imports, obviously, some people have won out more than others. So Anna, in the region, who has it been that's really kind of been benefiting from this strong Chinese demand?
The ASEAN steel mills enjoy a duty waiver, import duty waiver, due to the ASEAN-China Free Trade Agreement. So we have seen recently the exporters in Vietnam and Malaysia, and somewhat a little bit from Indonesia, are benefiting from exports to China. The duty exemption for billet is 2%, for hot rolled coil is 3%. Mills that have Chinese investments also are exporting to China because of established trading relationships. These are Alliance Eastern in Malaysia and Tersent in Indonesia. Interestingly, last month we had Formosa Hunting exporting hot rolled coil to China. This is again it's a reversal of the flow. Vietnamese hot rolled coil is now going to China because of the weaker domestic market in Vietnam. And last but least, I forgot to mention, Hua Fat has been exporting large volumes of billet to China.
So quite a lot of investments and quite a lot of mills there that have increased capacity recently, that are now benefiting or perhaps being sustained by high Chinese demand, even when local demand is strong.
Yeah.
How has this?
Sorry, you were saying that it was, thank God for China, because they're soaking in all the excess capacity in Southeast Asia because of weak markets here.
Yeah. So talking about weak markets, how has this impacted the traditional Southeast Asian importers? Some countries don't have export capacities, so how are they being affected?
Okay, we have to compete with China right now to get steel into the region. So the prices have shot up, as everyone would know by now. Hot rolled coil prices have gone up by about nearly 15% in Vietnam. And for billet in Manila, the prices have gone up by nearly 6%. This is only month on month. So the recovery for the steel mills here are slower because they cannot pay the prices. If they were to buy any steel, it will be mostly for just replenish. It will be small quantities. They won't do anything like high inventory accumulation kind of, buying of steel because there's so much uncertainties right now in the region.
Yeah. So I think on that point that fits in quite well with our next poll. So I'd like to bring that up, and then I'll put the responses back to you. If we could have the next poll up, please. So when will Southeast Asian steel demand recover to 2019 levels? We've got three options here: by the end of this year, next year, or not until after 2021. Obviously, local demand has been hit very hard and everybody would like it to come back. I think most of the market is waiting for demand to recover, but it's not a simple question. So let's see how the responses come in. We have around another 30 seconds left in order to vote. We have a slightly less clear than the first poll. We have two options which are clearly leading, one very clearly falling behind. Around 10 seconds left now. We're over 70% voted, so we're close. Okay, thank you. So we have a very close split really between people who expect demand to recover next year and people who think demand will not recover until after 2021. Only 7% of people think demand will recover to 2019 levels this year. So clearly not very many optimists out there, and 41% who are quite pessimistic, certainly more pessimistic than the Southeast Asian Iron and Steel Institute, who expect recovery in 2021. Thank you. I'd like to put that to the panel now. Rajiv, what do you see? Your company has exposure. You guys sell out to a lot of Southeast Asia. What's your take on this?
See, if I give a flavor of the steel consumption in Southeast Asia, almost 73% or 73 to 75% of the steel gets consumed in the construction sector. Okay, so it's a very construction dominated region, followed by auto at around 10-11%, followed by shipbuilding, mechanical machines, and packaging. Normally, whenever there's a crisis, whether it was 2008, 1997, or just now, construction typically gets less impacted because this is an area where government support comes handy. At the same time, construction activities are generally more localized and they are not so much impacted by international trade frictions. Okay, so in this situation, each country in the region, Southeast Asia, have also kind of announced a lot of support packages. Okay, and I expect fair amount of them will get into infrastructure support. So considering a high ratio of steel getting consumed in construction, okay, I would expect the region to start recovering. It's a matter of time when money gets allocated, the schemes get approved, and when they get rolled out. So to that extent, I also tend to agree that we don't expect much in 2020. We should actually see a better recovery in 2021. Auto is going to take longer, considering that the disposable incomes are an issue and there are also changing norms in the industry. Within the region, if we see, there are countries like Vietnam or Philippines where proportion of construction is beyond 80%. So I would expect them to recover a little bit faster. And then there is a band of Thailand, Indonesia, Malaysia, where construction is around 60-70. And then you've got auto, shipbuilding, and others accounting for balance, 30 to 40%. My take is there the recovery is going to be a little slower. And then there is a set of countries like Laos, Cambodia, where The local support or the government support is not of the same order, and my take is these are more dependent on foreign investments. So I would expect their recovery to be even longer in the absence of support. So all in all, I think 2020 we should see something like maybe 2 to 4% drop, but 2021 things should pick up in the region.
Thank you. Yeah, I think that's a very interesting way of looking at it, the proportion that is really driven by construction. I think it's something that melds very well with what we see in China as well. And then, construction and infrastructure is really where the government has the most leverage to support the economy, and areas that are driven by consumption are slightly slower to recover. Anna, I think this also fits with something that you were telling me earlier about different markets focusing on boosting their domestic economies and how that is impacting trade. Would you like to share with me what you've been hearing there?
I think that the feeling among the traders is much more severe. They don't think that that there will be just a slight drop of like single-digit drop in the demand this year on year. A lot of it will depend on COVID, on governments having to control or any kind of outbreaks coming on, and that is very unpredictable. And this factor is coming into the system. There's very lots of uncertainty. I think there's problems about cash flow, financing, and it's all because of this COVID, and like this cautiousness, and how do you actually go forward? So I'm not so sure that it'll be so good. Even this year, I mean, they're saying for sure next year. That's why I think you have that poll saying that. I was quite surprised. Half of them, of our viewers, actually think that it could even be so long, the kind of rebound that Southeast Asia is used to, maybe 10% growth, will only come in 2022. So I don't know. So I'm not too sure. It all depends on COVID. Like in Thailand, right? Lots of it is all dependent. The country is dependent on tourism. How do you actually manage like a growth? Then the government is so busy trying just to contain infections, just like in Vietnam. That's why there's some pessimism. Yeah,
sure. So a lot of people seem to have this view then that the demand will not recover fully till 2022. How do these outlooks kind of impact steel production in the region? Rajiv, wonder if you could come in there and say how mills are responding. When do you think production levels regionally may pick up again?
Yeah, so this is a challenge for all the companies, including ours, but I think each company has to chalk out what are their set of priorities. For us, as we rightly heard, till the vaccine of COVID is found or till a human body becomes immune, the risk remains. So to that extent, the first priority remains in terms of safety and well-being, because if anything goes wrong, it impacts the employee and the group of employees, but it also impacts the production system, because each country have a strict lockdown control mechanisms if anything gets infected. At the same time, cash is important because of the uncertainty. You don't know when there could be a full stop. In the same situation, there are areas where there's a drop in demand, but there are opportunities where the supply has got impacted. See, at the end of the day, within the region, there is a fair amount of flow of steel that happens within the region, and also going up to, say, China, getting into Australia system, and till some time back also into India. So the catch is to kind of keep a very close contact with the customer to see if there is any opportunity, and keep some flexibility in the operation system so that on a short notice that opportunity can be capitalized. Because I don't think so many people are getting into speculative mode. It is too risky to kind of buy more or buy less. I think people tend to maintain a flow and kind to serve on a short notice whatever can be collected. The subject on Thailand, for example, government has been releasing money for construction. Some of them could be for infrastructure projects. Some could be to support the provinces in terms of employment, and some revenue to the people. So things have been moving in Thailand, I would say, better than a few other geographies. Okay, so the approach is cautious, but not kind of keep your eyes closed. There are opportunities even in these difficult times.
So if there's opportunities and there's risks through this whole period, obviously it's one thing to speak about that in general terms, the way that we do as analysts, but for a company actually operating in this environment, how have you been able to kind of plan and respond to the uncertainties around the coronavirus, and how to manage risks and spot opportunities?
Yeah, so since in some of the markets, the domestic demand has got impacted, so there is also a lookout for export opportunity, though export realizations are not the best because many countries are now resorting to export, trying to cover part of the domestic drop in the demand. Our view is to kind of get in and lock in the orders, okay, as much as possible. Try to back up with adequate raw material. In Thailand, we run through electric arc furnace through scrap based, but we also buy billets. So we toggle, what to produce in-house and what to buy billets to make sure that we are adequately covered for material. And since cash is critical, we do a next 90 days daily cash planning, what's going to be my incoming and outgoing, just to make sure that we don't get into a surprise situation. And it also helps us to plan what to buy. If there's a good parcel of billet available, when can we plug in to fit into our cash flow situation. And last but not the least, maintain with customers, suppliers, and employees not to let the guard down, because the risk remains. Okay, so it's a more, I would say, a micromanagement. We can't kind of let go the situation, because an opportunity lost is lost. There are not too many just now, but we don't want to miss any.
So there's a lot of focus on detail and responding rapidly to those changes. One question I'd like to ask you, Anna. We, at our last conference, we came up with some numbers for investment in new capacity in Southeast Asia. We had 60+ million tons a year of capacity planned for Southeast Asia. Some of that has come online. A lot of it is still in theory to come online, but obviously the situation has changed dramatically in terms of the short-term outlook for demand. What are your expectations, and what are you hearing about how the current uncertainties might impact those investments?
Actually, not hearing anything much about investments. It's more like survival mode, I would say, right now. It's been quite bad. I hear of existing plants not running at capacities. I'm hearing that it's easier to run on one line and sell at domestic prices because it's higher than to export. Just looking at why Southeast Asian mills want to export, it would indicate to you that the domestic markets here are quite bad. But actually, I do have a question for Rajiv. Is it okay if I were to ask it to him now about Indian steel? Because Indian steel is very, very, very prominent in the export markets right now. I was wondering, I'm hearing right now that we don't get many Indian offers right now because the offers have all dried up because the Indian steel market is booming. So, and I've asked around, and it appears it's booming because people are stockpiling in India ahead of peak season. Maybe you can elaborate more about this, Rajiv.
Okay, yeah, I'll share a bit of outside-in view. I don't operate in India. I'm based out of Thailand, but we keep a close watch on what's happening in India. See, India got into one of the most severe lockdowns in the world started somewhere around 20th of March, and it continued for almost 3 months. But India has a lot of steel making capacity, and a lot of it comes from the blast furnace route. So it is difficult to throttle those capacities. It's easier to throttle an electric arc furnace, but not so easy on blast furnace. And as a result, right from April, May, June, many big steel companies in India were resorting to heavy exports. I'm aware of some companies even doing more than 50-60% of their output into export because they wanted a certain cash flow to be maintained, even though the realizations were not the best. But the idea is you don't want to go take down blast furnaces below a certain operating level, because then it becomes a technical issue. Okay. At the same time, you want the cash cycle to be rotated, because many of those companies are also heavily leveraged, and there are interest and other things to be paid. Now, since I would say July, things have started to open up in India, even though not fully, but things have started to open up. And we see already situation improving quite a good level in the rural demand. India has a predominant, percentage of people living outside the cities, and the rural demand supports, fair amount of products like rebars, like sale of tractors, two-wheelers. This is the kind of products that move into rural areas. So since July, we are seeing things improving on that front. Situation is not good in auto. 2019, even before COVID, auto was in a bad shape because there were liquidity issues in India last year. At the same time, India had mandated to go to BS6 or Euro 6, compliant vehicles with a certain timeline. And there was a lot of pipeline of Euro 4 equivalent. India moved rightly from 4 to 6, and hence auto already was struggling, and then COVID stuck. So 2020 auto, I would say, is in a bad shape, and it will take even longer, to recover. So in this situation where things are improving, and when we see consumption data in India, I was also reading July sales were like 10% higher than June, but still like 30% lower than July last year. So there is a long way to go, but every month things are picking up and things are improving. In this situation, many Indian companies have cut down on export offers, okay, because the domestic demand is improving, domestic realizations are improving, and domestic realizations are better than export. Okay, India also has this monsoon season till say September, and hence many activities which are in the outside are not, so well. But October onwards, business situation and steel situation in India improves. So maybe part of the pull in of material, which is also supporting the prices, could be some people are trying to collect material. At the same time, channel was dry, because of less buying in the last, since I would say March, buying had stopped. So there was no inventory in the channel. Part of it is filling the channel, and part of it may be getting ready post October, when things are going to be better. So all in all, I would expect export offers from India to go down. It will come back to what used to be in the past, getting into ASEAN region, but just now India is also exporting to China. I don't expect, that to be a sustainable model, but hot roll coils, some billets, will flow from east of India into Southeast Asia.
Thanks, Rajiv. So there's some changes there. I'd like to ask you something from one of our delegates about your company specifically. So obviously Tata Steel Thailand and Nat Steel in Singapore, which you also oversee. Going back around a year now, there was parts of those assets were available for sale. And in the current climate, we've been talking about changes in investment strategies and so on. I wonder what your company's current standpoint is in terms of Tata Steel Thailand and Nat Steel and its future going forward.
See, Tata Steel embarked upon looking for a partner maybe 1.5 years ago for its Southeast Asian operations, who have a longer term view of the region and who have a different kind of ambition. At the same time, if you will recollect, Tata Steel India has invested a lot of money in India during acquisition of Bhushan Steel. Then we acquired Usha Martin. Then we are also expanding our operations in the new site at Kalinganagar. So put together, there was a need felt, to kind of prune down our presence in Southeast Asia. I would say there is no change in that strategy. We continue to be in discussion with potential partners. Because of COVID, I would expect things have gone a bit slow. People are trying to douse fire first, then to get into a next level of things. But the process is on, maybe on a lower gear.
Sure. Yeah. Yeah, certainly coronavirus has interrupted a lot of people's standard plans and operations. I'd like to pivot a little bit now. One of the issues coming forward is going to be around raw materials, and one of the risks to that outlook is what happens with China and its scrap imports. This is something that's going to be affecting steelmakers globally. So currently, of course, China does not really import significant amounts of scrap. It has a licensing policy, and most ferrous scrap imports are banned, or at least very severely restricted. Mariam, I wonder if you could come in and tell us your outlook on any changes to that policy.
Okay, so for China, the scrap imports is expected to start as soon as next year. Currently, the China Association of Metal Scrap Utilization and also the China Metallurgical Industry Planning and Research Institute, the two official departments, they are drafting the new proposed regulations for scrap imports. The other thing is the reduction of imports also reflected in the increase of import quotas. That is the China's scrap importing companies, they are importing in quotas, and the new approved quotas in the second half of this year has seen a very sharp increase in quantity starting from the second half of this year. So the steel mills, they are looking for the policy support to restart the scrap imports. For them, they are looking for decrease production costs. But from other market people saying that it also shows another trend that China's big demand for scrap may drive the global scrap prices up. Thank you.
Yeah, in 2009, I remember China became the second largest scrap importer globally, very briefly. If China does allow a significant amount of scrap imports and iron ore prices remain high, any sudden spurt from China in terms of buying international scrap supplies could have a pretty significant impact on that cost relationship. Rajiv, as you operate EAFs, this will be of interest to you. So I'm interested in hearing what you expect to happen on this and how you can plan to mitigate any risks from that as a company.
Yes, this remains a meaningful risk, in this situation because of the sheer size of China. Because of no imports allowed today, the domestic scrap prices in China, I think, are almost $60 to $80 higher than the international market. And in a way, it also supports, more blast furnace route steel making in China, even though iron ore is almost touching $120. But what I understand, it is still cheaper than what one would have used, or spent by buying scrap at those prices. So one is, as and when market opens, there is going to be a balancing of domestic scrap prices, which means EF in China will be slightly more competitive. Okay, if the volumes are meaningful, I don't know the number, but if it's meaningful, it can also do a little bit of counterweight to iron ore, at least sentiment-wise. Today, it is a one-way traffic. As far as region goes, yes, it's a matter of concern as and when it happens, because China can act like a big magnet. Just now what's happening on iron ore and billet is that this is a monsoon season. This is not the best season for rebar prices. On top of it, you have a COVID challenge. So this is not a time to be in a market where rebar prices in the region are maybe $460, $480 and billet is at $430, $435. That's not the kind of position we would be very happy to be in. But you can't control it because a lot of billets are actually floating into China. So the risks remain. As far as what we can do, I think each company is too small to kind of impact anything on the international flow. We'll have to adjust our sales what happen. But definitely 2-3 things may happen. One is I think the companies will have to engage with their governments to at least, if possible, protect domestic scrap. Engage with the government to see can we avoid export of scrap from each of these countries, at least to keep it for domestic players, because there is no other source of raw material. Secondly, I think the dependence on billets will go up. So to that extent, the billet play in the region can be a little bit more active than what it is just now. And since there'll be a pressure on cost, what can be done to mitigate the situation? There could be, some shift from EF to IF because it helps to mitigate part of the cost, and region rebars get accepted from the IF route. So some companies may even think in that direction.
Interesting. So potentially an increase in induction furnace production relative to EAF, and also an increase in kind of resource nationalism around scrap. And that will obviously work for economies which have a significant amount of scrap generation. But what about some of the rest of Southeast Asia? I'm thinking, for example, Vietnam, which imports a large amount of scrap. What options would they have to deal with that situation?
See, if the scrap price gets to a certain elevated level, it has to be recovered from the market in terms of finished good price. Okay, there could be a temporary blip. Sometime the steel makers may suffer, but I don't think so. It's going to be a very stable situation that supply of finished product can continue if the steel companies are not able to recover their cost. So what is also happening nowadays, big consumers of rebars, they also track scrap prices. Okay, so everybody has kind of understood the part dynamics of steel making companies. So we also sometimes sense in Thailand when scrap prices started to go up, we start getting a little bit more inquiries, which means customers also expect that rebar prices may follow. So I would think that beyond a certain level, finished good price has to kind of come in some tandem with these scrap prices, even in countries like Vietnam.
Sure. Anna, did you want to add something there?
No, I think just like all the other imports that Southeast Asia has, Southeast Asia is a price taker. We have no choice. So if China were to come in and import, you would just have to pay whatever China's paying because it's so big. It's been interesting, it's like you have the induction furnaces, you mentioned that, are using scrap. And recently we see induction furnace mills in Vietnam actually importing scrap right now in Vietnam, although the domestic market there is so bad because they are exporting long products to China and to the Philippines. So I think you're right, Rajiv. And if steel prices go up, there'll be a way for the raw materials. The mills will find a way to pay for the raw materials to make their steel. But if the finished steel prices don't come up domestically, I think there's no choice. I think the mills, the users in a country, if they need, they'll just have to pay eventually. But I'm not sure right now because things are pretty much a little bit chaotic right now with lockdowns happening right now.
So I'll just give a one-liner to that. See, in most countries, import of rebar is not easy. Even in Southeast Asia, other than Singapore and Hong Kong, other countries practically don't allow flow in of rebars. Okay, so if scrap prices or billet prices go to an abnormal level, there will be some supply disruptions. Everybody does not have deep pockets, and somebody will have to shut down, which in a way will balance the supply in the market. Okay, you can't get in rebars into Vietnam and Indonesia and Thailand from outside. It has to be produced inside, and it has to kind of flow into the market.
Yeah, so that increases the kind of direct impact on producers, right? That ability to trade is curtailed. Yeah, interesting, Anna, that China is now importing induction furnace steel after all of the drama of the last 4 years, moving all of the induction furnaces out to Southeast Asia. I'm aware of the time. We're around 10 minutes close to the end, and there's a couple of issues that we haven't spoken about yet. So I'd like to talk a little bit about iron ore, and I'd like to kick that off with another poll. So if we could have the third poll up, please. Okay, so when will iron ore prices fall back under $100 a ton? As you said, Rajiv, we're running roughly around $120 a ton mark at the moment. The options are, will they fall under $100 a ton before Q4 by the end of the year, or not until 2021? We have around another 30 seconds or so to vote, so please get your votes in. Looking similar to the last poll, one option is very clearly falling behind. The other two options are really neck and neck at the moment. Around 15 seconds to go, and almost 70% of people have voted, so just a few more seconds and we'll close the poll. Okay, hope you've all got your votes in. So only 10% think prices will fall before Q4. The optimism in iron ore markets seems to have come back with force. 47% just in the lead expects prices to fall under $100 by the end of the year, but 43% now expect prices to stay over $100 a ton into 2021. That's quite an interesting poll, which we will probably be coming back to in future sessions of this webinar. If we look back a couple of months, not that far at all, really, people were generally expecting iron ore supply to pick up over the second half and iron ore prices to come down a little. That has really not happened. China has really been able to absorb as much iron ore as anybody can throw at it. And in fact, not only iron ore, China has also been importing pig iron, DRI, anything else it can. I'd like to put that poll to you. Rajiv, what are your expectations there for iron ore? When will prices come off?
I think 2020 it's likely to stay elevated because the situation in China remains strong. What I also understand that with the recent floods, there is going to be post-construction, so that is also going to support the system. And last but not the least, as other countries open up, that gives another flow option for iron ore. So all in all, the flow of iron ore is likely to remain more towards the consumer side. At the same time, the risk on supply side remains. So I think companies are likely to keep enough buffer that will keep iron ore on the elevated side, at least for this year.
Mm-hmm. And Mariam, this really comes down to how much iron ore China can absorb. What are your expectations for steel production in China going forward?
In terms of the China steel production, the latest news is that the MPI is talking about the new 80 million tons of the new capacity commissioned in 2020. So this have a very huge impact to the market supply side, which also may drop the market confidence up a little bit by on the iron ore side, because the new capacity means more demand for iron ore.
Yeah, it's interesting just looking over the reports that come out of China is that the number of capacity projects that are still ongoing in China. And obviously there are some limitations on this in terms of the fact that their capacity replacement projects, so some capacity has to close in order to justify those new commissionings. But over recent years, there has been a trend of some of that new capacity being misreported and being slightly larger than planned. And it seems like overall capacity is still surprisingly firm, despite all of the government's attempts to limit capacity growth in China. So that does give a fairly strong outlook for Chinese iron ore, at least for this year, and I think at least until China does import more scrap, when perhaps the support for blast furnace activity is slightly taken away. I wonder, Rajiv, if you have a view about blast furnaces outside of China. We've seen a kind of a mixed trend in Asia, really. We've seen, in Korea, you had POSCO shut down Gwangyang Blast Furnace 3, that restarted in July. But then you have in Japan, you have a large number of blast furnaces closed. Do you expect blast furnace producers in Japan and perhaps also in the rest of Southeast Asia, in Indonesia, for example, to restart blast furnaces in the near future?
See, there is definitely a cost and a quality advantage of the steel that comes out from the blast furnace route. But at the same time, blast furnace cannot be switched on and switched off. So in a sense, one need to have a fair amount of order surety, if you want to supply. Secondly, in the last 5 months, with a lot of lockdowns, I think there is a greater awareness on environment, which has also propped up around the world. And I would expect going ahead, it will directly or indirectly support more steel making through scrap-based opportunities. Okay, so going ahead, temporarily, I think each company will have to understand what is their proportion of how secure is their order book, and accordingly, they will have to take a call on what level of operations to run. But at the same time, I would also expect relatively higher investments to shift towards scrap based, which adds to flexibility in the operations when you can switch off, switch on relatively easy, and it also supports the CO2 emissions issues that's going to come up more and more.
Yeah, I think that flexibility with scrap and the emissions are also something that we've been following very closely in China. Obviously, China now has its next 5-year plan is under consultation and will be released in theory in the coming year. And the focus again is expected to be on increased scrap utilization, lower emissions for the steel industry, a greater consolidation of capacity. Those goals have always been there. It's really been putting it into practice, which has been difficult, and there's been a lot of resistance on the ground to that. We're getting close to the end, and there's one question that I would very much like to ask your opinion on. And that is that we've seen in the last few months growing tensions between the USA and China. Southeast Asia, of course, is a collection of countries, none of which on their own can really have a strong impact on the direction of that. And it's also a region that has vulnerability to currency issues and so on resulting from that. I wonder what you expect in terms of how the region might be impacted, and perhaps how steelmakers can keep their eye out for risks and plan around that.
Yeah, so the steel trade from ASEAN to US is not significant, but it is very significant with China. China is the largest steel supplier to the ASEAN region. Okay. At the same time, with the issues which are going on between US and China for the last few years, we are also seeing a movement of Chinese companies, not only in steel, but other products also into ASEAN region. Okay, so which gives another opportunity for new investments, new constructions, things to happen. And last but not the least, I think China is also actively pursuing BRI with many countries in ASEAN region. Okay, so in a way, it will support a lot of infrastructure development, whether it is in Malaysia, whether it is in Thailand, Laos. Many countries are going to see infrastructure support coming through China. So in a way, I would say the current situation from a steel point of view, and the fact that we are still a construction dominated region, greater engagement with China, I think, will help the region from a steel sales point of view. But one of the risks which I foresee is that it's going to increase Chinese influence, into this area. Now, how does it pan out? Only time will say. Okay, but BRI and greater engagement of China, I think, is good for steel trade and steel manufacturing here.
So it's really down to that same contradiction between wanting the investment and the involvement, but not necessarily wanting any of the political risk. And there's always, of course, a risk of local nationalism being provoked as well, right? A lot of nationalistic policies perhaps blocking investment. So that's going to be an interesting one going forward. We've reached the hour, so we're close to running out of time. But before we finish, Rajiv, I'd like to ask you, what are your takeaways from the last hour of discussion? What points do you want to highlight?
I think one of the takes is that caution is the word, okay, which we need to be careful of. Secondly, I still get a sense that situation in China continues to be on the bullish side, though what I also read that current level of inventories are almost 30% higher than what they were 1 year ago. Okay, and sometimes Chinese market behaves in a certain manner once the inventory level moves in a certain direction. But all in all, there is, say, let's say, light at the end of the tunnel, at least for the next few months. And in a way, then manufacturers like us need to be prepared for a situation where whether it is iron ore, billet, is likely to stay elevated, and scrap may follow. Considering kind of cross benchmarking. So caution, precaution, and keeping a close watch on the operations. I think that's important for us.
Yeah, caution and good planning. That's always good. Okay, well, we'll have to wrap it up there. So thank you again very much for joining us, Ranjiv Mangal from Tata Steel Thailand, and from Kallanish, Mariam Wang and Anna Lowe. We will be sending out written responses to questions. I know there's been quite a large number of questions coming up on my panel. I haven't been able to ask the panel all of them. So we will put together written answers and put those out to all of the attendees in the next few days. The webinar will also be available on YouTube as a recording. That should be available within the next 24 to 48 hours, assuming no technical issues. And please also remember, we have other webinars coming up. We have our Global Steel Markets webinar and our Raw Materials webinar. And we also hope to have another Asian Steel Markets talking points in the coming months as well. We will notify you all of that by email. So thank you again for everybody for joining us, and we hope to see you again.
Thank you.